Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in and you guys are going to absolutely freak out once I go over what Zillow is forecasting this year in 2023. We cannot get Zillow for the life of us to stay conservative. Zillow's actually changed their forecast and now forecasting additional price growth to happen this year. And let's not forget, you guys, Zillow lost hundreds of millions of dollars at the end of 2021 when everyone else started making a whole bunch of money. So they continue to lose. And don't forget this as well. Zillow was wrong almost the entire year in 2022 and essentially helped absolutely no one figure out what's happening in the housing market. And what I'm saying, you guys, is this: they are continuing that pattern. And we're going to look into this article and see exactly what Zillow is saying. Now, after that, after we see what Zillow is saying, I'm also going to take us to another article so that we can see what other people are saying. And there are still many other economists that are predicting a continuation of price crashing. I believe that the housing market crash was put on pause as a result of consumer spending and then propping up the housing market and overall propping up the economy. And I also believe that's the only reason that we're not in recession right now. So at the end of this video, we're going to jump into a video from CNBC that breaks down why we're not in recession right now and the overall health of the consumer, because it's really important to look outside of Zillow to get a full understanding of not only just the housing market, but in the economy as well. But remember, you guys, I'm not a financial advisor, even though my bio is as a realtor, loan officer, instructor, renter, father, husband, content creator. And for all of those hats that I wear, guys, do me a favor. Like this video, subscribe if you haven't already. And please, guys, shoot me a comment below because you already know I absolutely love hearing from you. So we'll get started right now. But before I do, you guys sit down, put your seatbelt on, because this is the same old Zillow, the same old toxic cheerleading. The name of this article is Zillow Home Value and Sales Forecast for May of 2023. Couple bullet points here. Zillow forecasts that home values will grow. Yes, that's right. Will grow 3.9% in 2023. You want to know who else feels that it's going to grow about 3.9%? Johnny Fly. Johnny Fly thinks that home values this year are going to go up 5%. Johnny, you're worse than Zillow. Moving on. And yes, I just said that, Johnny. You're welcome. That is a significant increase from last month's forecast. You guys see what I'm saying? Like, Zillow can't even wait. It's like any second something good happens, they're gonna be like, yeah, hit the alarm. It's time to be toxic cheerleaders and overly optimistic once again. Anyways, I'm so sorry. I can't even make it through this article. This is a short article, by the way. Zillow expects 4.36 million home sales in 2023, which would mark a 13% decline from 2022. Only 13% decline? Okay, whatever. Zillow has significantly revised its outlook for home value growth this year, now projecting a 3.9% increase for 2023. Monthly home value growth accelerated in April, roughly matching what would have been expected pre-pandemic for the second month in a row, helping drive Zillow's forecast higher. So do y'all see what I mean? They're not even forecasting. They're like, which direction of the housing market's going in? And then we're just going to add some on top of that. That's really all they're doing. I mean, how have they helped us? Seriously, think about it. How has Zillow helped us at all? Anyways, moving on. Zillow's long-term expectation for mortgage rates has been revised downward, which would improve housing affordability for prospective home buyers and provide a tailwind to housing demand. The looming threat of a debt default could send mortgage rates soaring without resolution, though that appears unlikely. I notice they're not talking about a resurgence of inflation as well. Imagine a resurgence of inflation and how bad that would actually be. I mean, it would be like round two of everyone losing money. In addition, Zillow now forecasts lower for sale inventory than it had been forecasting in prior months. So overall, they're saying the reason why we're adjusting our forecast is because now at this time, we expect less inventory and we expect lower interest rates. And as a result of less inventory and lower interest rates, that will continue to fuel demand. And let me know what you guys think about that. And again, I would think normally they would be right in a normal market. That would be accurate, but they're not accounting for the 48% increase in home values in about 2.5 years. and the insane unaffordability and the fact that the only reason people are buying right now is the massive excess savings that they have from money printing and COVID and stimulus. How do I know that? Because I saved all my money and I am one of those consumers. Zillow's forecast for existing home sales this year was little changed from a month ago, revising upward slightly from 4.3 to 4.36 million. In expectation for lower mortgage rates, a boom for demand was offset by the lower projection of inventory. The forecasted 4.36 million existing home sales in 2023 would be 13% less than 2022. Now, I'm going to tell you guys this. If they're right and all we are is 13% under last year, I mean, think about how shocking that would be. Think about how many consumers are locked into their house. Think of the gap of home ownership. Think of pre-2022 home ownership versus post-2022 home ownership. I mean, they're just making the divide even larger instead of waiting. And I don't want to wait either, right? I don't want to wait either, but I sure as heck don't want to be trapped in my house and all stressed out like the 85% of other millennials that purchased in 2023. Again, if you guys don't want to listen to me, if you don't want to listen to realtors, if you don't want to listen to anyone, at least listen to the people that have recently purchased. What are they saying? Well, if it's a new home build, generally they're saying it's a piece of garbage, and I can't wait to give you guys that interview. And if it's a resale, they're saying I rushed it, I don't like the house, the payment's too unaffordable, and the house is falling apart. Y'all, this is the worst housing market in history. Demand is being fueled by the excess savings. That's the only thing. That's the only conclusion I have here. Excess savings, hot labor market. It's unbelievable, really. Regardless, though, we see clearly here that Zillow wants to remain optimistic. So let's pull up another article that was released a little bit before this one, and let's see what other people have to say that are a little bit more cautious. So we'll quickly dig into an insider article titled "A Former IMF Official Says It's Very Likely U.S. Home Prices Fall 15 to 20%, and he cites the reason why, as credit crunch creates a lose-lose situation for housing sector and the debt ceiling standoff threatens a substantial recession." Let's dig in more. This is consumer sentiment as far as credit tightening. Do y'all see the massive skyrocketing upward trend right there? Do y'all see that? Consumer sentiment is so important. The emotional aspect of purchasing is incredibly powerful. But we can see here that, at least everyone expects credit tightening. I could tell you guys as a residential loan officer that I personally haven't seen much credit tightening. It could be possibly a little bit harder to get files accepted through automated underwriting, so they can tighten that up a little bit. But as far as actual hard guideline changes, I haven't seen any of that. So I'm personally, I'm still waiting for that to happen. But as we can see here, consumers expect it to happen or are already experiencing it, credit cards, car loans, and things of that nature. And now read this. On the other hand, a credit crunch puts the U.S. economy at significant risk of recession. In a recession, unemployment levels and spending falls. Unemployment levels rise and spending falls. This is also bad for the demand side of the equation in the housing market. Housing gets hit kind of two ways here. Housing gets hit by tighter credit conditions, but then it also gets hit if the economy goes into recession. One of the charts that I showed you all in my last videos is how closely unemployment tracks mortgage delinquency. So if we have a massive spike in unemployment, odds are we're also going to have a massive spike in mortgage delinquency. Latchman reiterated his call for 2022 that home prices will fall 15 to 20% from peak to trough, and said such an outcome is very likely, but that it would take time. So again, y'all, be patient. Home prices are already down 4.9% from their peak in June of 2022 to February 2023. During the mid-2000s housing crisis, the index fell 27%. Home prices rose slightly, 0.17%, from January to February, but it remains unclear whether it will be a sustainable bottom. And you all know that I'm saying it's not a sustainable bottom at all. And the consumer is greatly being affected here. In fact, you guys, we're about to listen to a video that's going to go into the fact that consumers, just to stay alive, are drowning in debt. So people have already lost here, but there's still an overwhelming amount of excess savings. And again, my hypothesis has been, if it was not for that excess savings, if it was not for the consumer spending, we would have a continuation of the price crash as well as a confirmed recession. But people got too much money and they should. We printed how many trillions of dollars? We printed about $5 trillion.
Wall Street remains braced for a recession, eventually. That's in part because consumers are poised to slow down their spending.
March was really kind of a big month in terms of spending slowdown, but it's not just bad news. We're not seeing like things deteriorating at a really rapid pace, but the slowdown is there.
But a recession may never materialize if consumers keep spending.
I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market.
I mean, it's been amazing how resilient in a way the consumer has been to this inflationary shock.
The consumer is still very strong. They're just spending differently.
People are still spending, and that has been important to the economy.
We've been talking about the possibility of recession for what felt like, a very, very long time. And for now, the global economy is holding up.
But some people are reining in their budgets.
I don't like to save my money, and that was part of the problem.
And I will have this video linked in my description if you guys want to watch the entire video, but I wanted to pause it there where that millennial said that she does not like saving her money, like most millennials as well. But I'm here to say it has never, ever, ever, that I have been alive anyways, been more important to save our money than it is right now. So we need to be saving, in my opinion, I am at least saving my money right now. But at least she's honest about the fact that she likes to spend her money. But I'm going to go into one more segment here that's going to go into credit.
I believe that people with less money may turn to credit to cover expenses in this economy.
I think it's really scary how much people are using credit to be able to afford what they need to have every day.
That sentiment shows up in this data set from the Bank of America Institute.
We care about credit utilization because we want to see how leveraged is a consumer, right? Are they really borrowing to finance their spending, or are they spending the money they already have?
Through the pandemic, Americans were using less credit, but that trend is starting to reverse. At the end of 2022, the average household had nearly $10,000 in credit card debt. Analysts believe that nationwide credit card debt may soon reach $1 trillion, an all-time high.
Putting everyday expenses on credit is so very dangerous because we know that as interest rates have been rising, so have rates on credit cards. So is the interest that you're paying on that money that you are indeed borrowing to pay for everyday expenses.
Credit card interest rates have never been higher, topping 20% nationwide in February. These interest rates move up and down depending on the central bank's federal funds rate. And these rates are generally only charged to customers who carry a monthly balance. As consumers run into headwinds, other parts of the economy are flashing warning signs too.
There's been a lot of speculation since the recent failures of a couple of large banks. This could spark a reduction in credit.
Banks are becoming much more nervous. They've seen a bit of deposit flight in some of these small and regional banks. This combination of higher borrowing costs and reduced access to credit, this double pincer movement, if you like, on the household and the corporate sector of America is, I think, what could be really, really concerning and damaging for the growth prospects.
So the interest rates on credit cards has never been that high. The average interest rate on a credit card, y'all, 20%. Credit card debt almost at $1 trillion. So what we see here is we see consumer debt exploding. What's next? What's after consumer debt explodes? Defaults. But here's the interesting thing that this pointed out. That's in the consumer side and in the business side. Both businesses and consumers are getting hit. And still, we have this slight rebound right now. And that should tell us just how much money printing there was. So it should take this long. But again, the next thing that I'm going to be looking for, y'all, and we already see it in the auto and in commercial real estate, is the defaults. Once we pick up defaults, in my opinion, that's when we're going to have the second stage of the financial collapse. In order for us to get there, the defaults need to continue to escalate out of control. And again, we are already seeing that in the used car business. In conclusion, let's just listen to the owners. Can we just listen to the current owners or recent owners of real estate? Let's not listen to me. Let's not listen to the realtors. Let's listen to them because their only interest is generally telling the truth because they feel victimized. And I don't want that to happen to you. And my warning to most people, right? Not all people, I know they're still able to find great deals, right? It's just really, really hard and most people can't. But my thing to most people is calm down, right? calm down. The housing market, y'all, is not going anywhere. There's still going to be houses coming on the market. There's still going to be people that need to sell their house. There will be a Fed pivot. We will get through a recession, and we will have more inventory, as we always do throughout the entire course of history. Now, other than that, you guys, I really hope you like this video. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.